At first glance, examining contemporary financial markets from the perspective of an ordinary investor, one can observe a picture of practical innocence and calculated optimism. We live in an era when index figures rise, media outlets daily proclaim new records and achievements, and the successes of major technology companies are told as stories of modern heroes and symbols of human progress. But beneath the attractive surface of these positive news and vibrant optimism lies something far more complex and cyclical, something much deeper and more ominous, something that in its inevitable essence has always led to tragic consequences for those who failed to recognize its warning signs in advance. One of the most fascinating and captivating aspects of technical market analysis lies in the fact that through careful examination of long-term historical data and market charts, fundamental patterns and regularities emerge that seem almost miraculous and mysterious in their precision and repeatability. These remarkable patterns are not the result of magic, mysticism, or mere coincidence. They reflect deep psychological cycles of humanity that relentlessly repeat from one generation to the next, like the heartbeat of nature itself. Greed and fear, hope and disappointment, optimism and pessimism, expressed through the complex prism of financial markets, create enormous wave-like movements and fluctuations that can be meticulously traced and analysed across entire centuries. The current complex situation with the S&P 500 index represents one such remarkable and critical moment in human financial history, when the distant past, the turbulent present, and an uncertain future seem strangely and intriguingly woven together in a single chart. If we construct a logarithmic diagram of the S&P 500 spanning approximately 100 years of continuous market history, from the 1920 to the present day, a remarkable line emerges before our eyes that appears as a golden trend of development and accumulation of civilization's wealth throughout the entire century. This endless line appears to those who first observe it as poetry of mathematics and economics, as eternal optimism, the relentless and continuous march of human progress and development. But if we examine this chart with extraordinary attention and insight, we notice something absolutely extraordinary and interesting for the professional. There exists one very specific and mysterious line of resistance that seemingly inevitably determines the highest and most dangerous points of the market throughout an entire century of history. This magical line, noted by many analysts as the Century-Spanning Trendline, passes with remarkable precision through the three most important and tragic peaks in American stock market history, through the fateful peak of 1929. When the bubble of speculation reached its culmination, through the dramatic peak of 2000, when the internet revolution revealed its true limits and constraints, and strikingly, tellingly, and symbolically, it touched the index at the beginning of 2025, signaling the possibility of history repeating itself. This touching represents the third contact point over a century, and therein lies its symbolic and practical importance. When three significant and meaningful touches of the same trendline occur across such an impressive span of time and through so many different economic epochs, this is no longer simple mathematical coincidence or chance. It clearly represents firm and unambiguous confirmation of some fundamental and inexorable law of market mechanics and psychology. Behind each of these three contact points stood extraordinary, nearly catastrophic consequences for millions of investors and for the economic reality of entire nations. When the S&P 500 first and dramatically touched this magical line in the grim year of 1929, no dark clouds were visible on the horizon of the American economy, no signs of impending catastrophe. On the contrary, a joyful atmosphere of celebration, euphoria, and innocent optimism permeated all of American society and the global economy. These were glorious, brilliant years, when new revolutionary technologies, Ford automobiles and products from other manufacturers, radio broadcasting voices through the ether, power transmission lines for delivering electrical energy, new means of communication seemed absolutely unlimited and inexhaustible sources of wealth and development. The people of that time believed and were deeply convinced that the workings of the economy they observed were fundamentally and radically different from everything previously witnessed, that it differed significantly from the cycles of past epochs, that humanity had finally managed to overcome old oscillations and transform the economy into a smooth curve of continuous growth and prosperity. No one thought this boom could end, or that it might reverse itself. Everyone was filled with optimism. Then, like thunder from a clear sky, came a brutal, devastating, and completely unprecedented crash that marked the beginning of the darkest and most painful epoch in modern financial history. The market fell catastrophically by 85%. Over a short period, it nearly completely and radically plummeted into the abyss of depression and despair. Millions of people lost absolutely everything they had, all their savings, their entire pensions, their every hope for a quiet retirement. An economy that seemed immovable and eternal proved to be as fragile and easily breakable as glass shattering against granite from a great height. The Great Depression engulfed the continent, bringing with it long, endless years of fear, unemployment, and social devastation. People remembered the lessons of 1929 for the rest of their lives. Or so they thought and believed. But human memory, as it happens, proved to be much shorter and more malleable than naive historians and optimists could have expected. People possess a remarkable and deeply rooted ability to forget the lessons of previous generations, especially when greed and speculative dust begin to accumulate and gain strength once again. When the incredible 1990 brought a truly revolutionary and transformative technology into the world, the worldwide internet, the global world repeated the same eternal scenario as in the golden and insatiable 1920. This time, the enchanting and seductive technology seemed truly unlimited in its possibilities, truly revolutionary and all-encompassing, truly capable of fundamentally and permanently changing everything on this planet and our very nature. Stock prices of young companies, named with exotic and magical names like sorcerers' incantations, rose to the heavens with frenzied speed and without reason. Companies without any profits, without any real products, without any genuine revenue, commanded absolutely fantastic billions of dollars. People who did not even fully understand what a web server was, or how data transmission protocols precisely worked, invested everything they had, small and large sums of their money, in shares of incomprehensible companies with wonderful names that sounded like something from the 21st century and science fiction novels. The market rose and climbed ever higher, and rose endlessly. And in August of the grim year 2000, the S&P 500 touched that same ancient century-spanning line of resistance for the second time, as if time itself were a screw turning through history. And again came a brutal crash, signaling the end of an era of innocent optimism and easy dollars. This time, the amplitude and energy of the fall were more destructive than in the grim year of 1929, yet still historically catastrophic and painful for those who fell directly under the wave of decline. The market fell more than 50% from its maximum dangerous heights and reached the depths. .com companies closed one after another in panicked rush, like a panel of fire extinguishing and dying. People who had given all their lifetime pension savings, investing them in cutting-edge technologies and young startups, sat through long sleepless nights, breathing shallowly, staring in horror at their computer screens and watching in real time as their entire future and security evaporated and dissolved like morning mist. Stock prices did not climb back to those magical and unreachable heights for many years, stretching across 2 full decades of searching. Other grave and painful lessons were learned by humanity's collective consciousness. This time, people, with quiet confidence, decided to be more cautious and prudent in their decisions. It seemed absolutely logical and right. But here's the paradox. We now live in 2025, and that same eternal scenario, like a returning play in the theatre of human sinful nature, repeats itself again and again on the world stage of human greed and speculation. The S&P 500 has risen to enormous, practically fantastic heights that defenseless investors of previous decades considered absolutely unreal and impossible. The index, which oscillated around the 4,000 mark just a few years ago, now touches marks near 7,000, continually reaching new maximums. What previously rightfully required years and years of gradual and organic growth is now implausibly achieved in just a few months of heated speculation and irrationality. The dynamics are absolutely striking, almost unreal and inexplicable by any rational logic. But what exactly is playing this enchanting music this time? This time we speak of artificial intelligence, of yet another revolution in computer technologies and computing. People say repeatedly and without end that this is truly revolutionary and brilliantly transformative. People confidently insist that this is truly radically different and unique and unrepeatable. People assure one another that this time the story will have a completely different ending. But those are the same ancient words, the same melodic songs and motifs, merely different numbers in the catalogue of human greed and nature that has not changed for thousands of years. A narrow set of gigantic companies, what the temple of the financial world calls the Magnificent Seven, with the largest capitalization, have monopolized more than half of the entire index gains in recent years. These colossal giants of artificial intelligence and information technology demonstrate growth rates in capitalization and value that you will not find in any economics textbook or financial journal or publication. Yet they also command valuations and quotations that seem and appear to be written not in reality but in science fiction, in the fantasies of futurists. For the third time, this truly sounds like a warning from history, a signal from fate, and the evolution of time itself. The century-spanning trendline of the S&P 500 tells us far more than mere numbers and cold statistics. It tells us of the deep and inexorable patterns of human nature and economics, of how dreams and hopes sometimes grow into collective madness, how collective energy can lift enormous markets to unstoppable and dangerous heights, but how uncertainty and naked reality inevitably return focus to fundamental values. The concentration of gains in just a handful of companies creates a particular fragility in market structure. If one of these Magnificent Seven disappoints investors, the correction could be significant. History teaches us that concentrated markets often precede crashes because the multi-layered diversification in their foundation is weak. When everything depends on a few points, when those points crack, everything falls. Beyond these technical observations, we must also consider the macroeconomic context. The Federal Reserve System of the United States, the leading force in America's monetary policy, has substantially shifted its position in recent years. After years when interest rates hovered near zero, they were raised to levels we have not seen in many decades. This creates a serious problem for markets priced based on assumptions of low rates. When the cost of money rises, any future cash flows, discounted at these higher rates, have less current value. This compresses stock valuations, particularly those valued based on distant and highly probable future earnings. Another interesting detail concerns how investment funds and institutional investors have built their positions. In a world where competition for returns is extraordinarily fierce and fund management fees depend on assets under management, naturally large sums of money flowed toward the most widespread assets. The S&P 500, being the largest and most liquid investment target for America, became a magnet for capital. This created a self-reinforcing growth loop. Money must go somewhere. It flows into the S&P 500, the S&P 500 rises, this attracts more money, the index rises further. This is the perfect recipe for a bubble. Scientific analysis of company valuation uses various metrics. One of the most popular is the price-to-earnings ratio, or P divided by E. For the American market as a whole, this ratio now stands at levels that can only be logically explained in exceptional circumstances. An ordinary company with ordinary growth rates should have a P divided by E that oscillates around a moderate figure. The current market P divided by E is considerably higher. This means the market is paying far more for each dollar of earnings than it paid in other periods. This could make sense if earnings were to surge dramatically in the future. But will they? You know what is most interesting about major crises? They often seem absolutely inevitable only after they have already occurred. Before them, people always say it is impossible, that this time is different, that we are smarter now. But the changes that precede crises have an abstract character. They do not seem important at the moment they occur. Certainly, when an analyst speaks of divergences in charts, it sounds like some technical abstraction. But when charts diverge, it means the market is beginning to lose traction. It means those with insight and understanding are beginning to exit. It is entirely possible, of course, that there will be yet another reversal, yet another sudden surge, yet another moment when your friend tells you he bought shares of some sensational new company and has already made good money. Markets have a surprising ability to make skeptics look foolish. But the fact that something did not happen yesterday does not mean it will not happen tomorrow. The Great Depression before 1929 was also not obvious to most people. The internet bubble seemed protected until it began to deflate. Financial history teaches us one very important truth. Markets, like people, have psychological cycles. These cycles reflect changes in human consciousness, in levels of confidence, in willingness to take risks. When people are optimistic, they are willing to pay more for stocks. When people are pessimistic, they want to sell. The problem lies in the fact that optimism and pessimism often swing from one extreme to another, missing a healthy rational balance. What we observe in the S&P 500 this year are classic signs of an overheated market. Not that everything is bad, that is not the point. The American economy is reasonably strong. Companies generate earnings. The technology sector is indeed developing. But the value of these positive developments has been extrapolated to incredible heights. This extrapolation, this faith in unlimited growth, this desire for tomorrow to be exponentially better than today has made the market vulnerable. One must understand that crashes are not truly sudden. They build slowly, like a generator of increasing tension, until at some point the tension exceeds the material's strength and it breaks. Signs of this tension are already visible. They are visible in the charts, visible in valuations, visible in the behavior of money, visible in the narrowing of market breadth. For those who have the ability to read these signs, they tell a simple story. Balance has been disrupted, and disruption is often followed by imbalance. What we see now is a moment when history will dance yet another step in its ancient dance. The golden trend line spanning 14 decades of history is probably not a miraculous predictor with supernatural powers. It is simply a line connecting points. But those points, each of them, marked the culmination of human greed, followed by correction. The third time, quite frankly, sounds like a warning. So what should one do? For those who understand this scenario, the wisest course is probably to be prepared. Prepared not for panic, not for selling everything in a rush, but prepared for adaptation. Prepared to reconsider whether your portfolios align with your true objectives. Prepared to maintain cash not to avoid the market, but to have the capacity to respond when opportunities emerge. And perhaps most importantly, prepared to remember that great crashes have always been followed by great opportunities. Those who had the courage to invest when tears and fear were present were often rewarded by fortune, but this requires significant emotional strength and a long-term vision that far from everyone possesses. The century-spanning trendline of the S&P 500 tells us of the deep and inexorable patterns of human nature and economics. It tells us how dreams and hopes sometimes grow into collective madness, how collective energy can lift enormous markets to unstoppable heights, but how uncertainty and reality inevitably return focus to fundamental values and basic sanity. What we are witnessing now, this moment in 2025, represents a critical juncture in financial history where the index has once again kissed that ancient line of resistance that history has marked as a harbinger of significant declines. This is the third time in 100 years that this mathematical and psychological pattern has manifested itself. For investors with the eyes to see and the ears to hear, the message seems clear. History does not repeat, but as the saying goes, it often rhymes, and sometimes the rhyme can be quite painful.